I'm going to add, I sent out another handout. I'm going to add something to it, but we'll first go through this part that we're going to go through now. But I'm going to add something here that this is what they call they call this quantitative materiality, and that it is looking at dollar amounts. And this is mostly what we think about when we think about materiality, is that we think about how many dollars would it take for you to conclude the financial statements are misstated. And it kind of goes into the kind of legal, fictional, reasonable person thing. What would a reasonable person think? There is no actual reasonable person. There's some people that think, oh, it should be accurate down to the penny. And then there's some people, well, I don't care. So, the reasonable person is somewhere in the middle there. And, that's what you're looking for, is people that, what would a reasonable person think would be an amount that if these financial statements were misstated by that amount, that they would be unfairly presented. And so that's kind of what we're looking at, is how the kind of the reasonableness of how these can be off. And we generally use these percentages because it makes a difference as far as what size the company is. If you say $1 million is material, well, to some companies that is material. That's huge. To some companies, that's nothing. So you basically look at their financial statements and try to figure out what would be reasonable given their financial statements. Okay, so what we're going to do is, so here's some rules of thumb that we have here. And this first one I'm going to use as our estimate. You could use any one of them. Let me use this one. This is in your finance class. They probably talk about the. Oops. What did I do here? Income before income taxes. It's a number they always talk about. I'll put this down. So, this is one we're going to use here. Now, I don't think I've told you guys this before. The way this kind of works is that you have larger companies and smaller companies. Or clients, I probably should say. Oops. Oh, let's get that a little closer. And so if you look at these percentages, you say, well, that's kind of a wide range. 3% to 10%. 10% is more than 3 times the size of 3, right? So which one do you use? Well, it actually depends on the size of the company. And shapes. Generally, the larger companies, you'll use a smaller percentage. I'll tell you why in a second. And the smaller companies, you use a larger percentage. And let's start with the smaller companies first. If it's a smaller company, well, I tell you, let's go down here. Let's go to this one. So company A, income before income tax is $150,000. Not bad, but I mean, they would have to be considered a smaller company. So we'd probably use more closely the upper range of the percentage. So 150,000 times, say, 10%. Equals 15,000. So for company A, we would allow up to $15,000. Oops, let's do this. The books be off by up to $15,000. And by the way, you never tell the client this. You tell the client that and they'll start making, bumping the books up by 14,000 or something. But anyway, so getting to overall materiality. So at 10%, you notice that it's a small company. And quite honestly, if there was a $15,000 error, you're probably not going to be sued for that. I mean, it costs more than $15,000 to have a lawsuit for that. So we allow for a larger percentage of it to be off just because the numbers are smaller. And because the numbers are smaller, it's less likely there's going to be lawsuits and those things that are risky. And even the overall economic, scheme of things, 15,000 isn't a huge amount for a lot of companies, even smaller companies. So we generally let the smaller companies have a larger percentage that they can be off by, simply because the numbers aren't that big. That changes at some point as the companies get bigger and bigger. So coming down here, we have a company that has income before income tax of say 50,000. So that's not a small company. That's a pretty good size one. It's not huge, it's not massive, but it's pretty good size. So we would probably pick something in between. Okay, so somebody pick something in between 3 and 10%, and we'll use it.
9.
9, okay. All right, so what is that? 4,000, 4,500,000? I don't know. Let me see here.
Yeah.
Okay. So this would be 4 million. $500,000. If we were counting inclusion, 9% would be the appropriate amount. That's what we'd be looking at as far as being material. Okay, coming down here, now this one is clearly a big company. Anytime you talk about billions in income, you're talking about some of the biggest companies in the world. So this one we would definitely use, say, 3%. What is that? $45 million. Oh, that's not. Got some of those zeros. So again, you can kind of see though that we hold the the bigger companies, we hold them to a kind of a tighter standard here, 3%, simply because the numbers are huge. You don't want to go into court saying that you missed a $45 million error, right? I mean, so because the companies have such huge dollar amounts, that's why we use a smaller percentage. Because going into court and saying that like say you missed a $45 million error or whatever or misstatement, is not going to be good. And people do sue. People will sue you for $45 million. It's funny how that works out. They won't sue you for 15, but they will sue you for $45 million. So this is kind of the way that we come up with a materiality for the companies. And again, it's judgment. Why did we use 10%? Why did we use this one? Rather than total revenues or total equity or whatever it is. By the way, I think the book uses. I'll have to look at it again. But these net assets and total equity are the same thing. They must just mean tangible assets or long-term assets or something. I'm not sure. But generally net assets and total equity are exactly the same. Net assets are just assets minus liabilities, which, you know, your balance sheet. Okay, that gives you your equity section. Okay. So these are just kind of, you know, kind of rules of thumb. Now, coming down here, there's two. I'm going to do something different here. Performance materiality. That is the new term. This is new. And when I say new term, it means that is more likely to be taught or tested, I should say, on the CPA exam. Tolerable misstatement is old, but you still see it for sampling. They'll still use that that term. But performance materiality is kind of the new thing, and tolerable misstatement is kind of the old terminology, although, like I say, it's still used for sampling. It still is a sampling term. They still use it. And basically what you do is you take whatever you came up with, a material amount, and say, okay, how much, now, you know, this is for the entire financial statement. So let's say company A. So they have 15,000, that's for the entire financial, the entire financial statements. We're saying that $15,000, if these are misstated by $15,000 in total, that the financial statements are misstated. Okay, well, here's the problem though. When you're looking at individual accounts, you're probably going to be looking for misstatements that are less than that total. And it also depends on the account. So if the overall materiality, I'm just going to use the 15,000 here. Oh, wait, I messed up my spacing. Okay, so if the overall materiality is 15,000, so what we're going to do, and by the way, it's not uncommon to have more than 15,000 allocated to the cost. Some books will say you just divide this by 2, and if any account is off by half as much as the total, then you have a problem. But basically what you're going to do is look for those errors that are, you know, it's going to be less than the overall for any given account. So let me see here. So we're going to kind of allocate this to these 3 accounts. And again, you might allocate more than 15,000 even. But you'd never allocate, let me say that differently. The total amount you allocate to any given account might be more than, in total, might be more than the 15,000. I've seen audits where they take the overall materiality, multiply by 3, and then divide it up among the accounts. Okay. So, for instance, cash. Cash is a strange account in that a lot of times it's a very small amount of the total assets, but everything goes through it. I think I talked about that. Didn't I talk about that? Maybe I did. But it's a lot of times it's a small percentage of the total assets, but all the accounts run through it. And another thing about cash, especially for a small company, you can audit it 100%. You can get the bank statements, you know, for all their bank statements, and you can actually go through events. So you might even set the materiality here. The performance materiality may be 0, and that's not uncommon for smaller companies. Look, we're going to get your bank statements, and we're going to figure out how much cash you have. And I did something wrong here. Okay, so then you may say, okay, for accounts receivable maybe, I'm just making this up, let's say 5,000. The accounts receivable, and then down here, maybe 10,000. Inventory is always kind of a headache. So maybe give a little bit more for the inventory. So you may have this overall materiality of this, and then this over here, this is what they would call the performance materiality. So when you're doing cash, you're not going to allow any materiality. You can get that down to the penny, and you can actually do that if it's a small place, especially for the cash. Accounts receivable, a little bit more difficult. You try contacting people and seeing what the accounts, what the true account receivable is and all that. It might be a little bit more work. And inventory is, it's always kind of a headache. So inventory, you might offer a little bit more materiality for that. Now, you're looking for misstatements by these amounts. Now, if any of these are more than that, you'd have a problem with it. If they're less than this, you wouldn't. And once you do the evaluation of your testing, you'll see if these are less than, they still have to be less than this, no matter what amounts you assign to these other accounts. In the end, it can't be more than that. Now, if you do come up with accounts that are off, you hope that the people running the company will make the changes. So it isn't just, like, you find a misstatement, okay, these are bad, and, here you get a terrible report. You tell them, look, this is misstated by, a good 12,000 or whatever it come up to. And you say, okay, you need to make the corrections there. And you hope that they do it. You want them to say, yeah, you're right, we'll make the changes. Or even if they don't agree with you, they'll make the changes so they don't get a bad audit report. So, but that's the whole point of the audit, is that those things that are misstated will be hopefully corrected, so that whoever gets the financial statements will be able to rely on them. Once you do the testing, it isn't just that if you find something that you throw in the towel on the client and say, this is bad, but yeah. So anyway, that's a kind of how we take the materiality. So you get an overall materiality, and then you do the performance, also known as, oops. Let's do that. These two are the same thing. This one, people, when they're talking about materiality for accounts, they generally use this term, and they generally use this term when they're talking about sampling. So for instance, if you do accounts receivable and you were to take a sample, they would call that the tolerable misstatement. The sample would be you'd have a tolerable misstatement of 5,000. Okay, so for testing, they will a lot of times use the term tolerable misstatement. They're the same thing, though. I don't know. I actually don't know how this term performance materiality came up, but they really started hitting it hard about 3 years ago. CPA exam. Okay, now comes the difficult part, in that I sent out a addendum, a accounting to Handout Part 8 additional information. It looks like this. And this is what we want to copy over. So if you go to that Handout Part 8 additional information I sent out, is anyone did not get that? I don't think I loaded that into Blackboard. I should have. So anyways, you get something that looks like this. Chapter 3 handout, Part 8 additional information. And this is qualitative materiality. I was going to cover this later, but I'm going to stick it in with this one, just to kind of round out materiality. And that is qualitative materiality. So from this, from this on down. Let me get all red. How about that? So I'm going to copy this. I'm going to stick it right at the bottom. So I'm going to copy it. Come over here. And before evidence, I'm going to paste this. I'm going to change it from red to black in a second. Probably getting a headache looking at it. I think I told you guys I had a house that had a red and black bathroom. They let the kids, the two boys, had decorate the bathroom any way they wanted, and they were into heavy metal. So the bathroom was black and red. It had a black and red rainbow over one side of it. Okay. So this is qualitative. And these are things that I'm going to change it to regular. So qualitative, it means that there are things that are beyond quantitative. So things that are beyond this up here, there are certain things that might be more material because of the nature of what they are. So a misstatement that is monetarily immaterial. So in other words, it's not, dollar-wise, it's not that big of a deal. If you're up here, if it was materiality was 15,000, maybe it's a $3,000 misstatement. However, it might be material if any of the following conditions exist. And this isn't all the things that could happen, but these are some of the ones that are more common. Okay, if the misstatement is there, maybe the company has shown sales increase every single year, but this year maybe they're a little off. They wouldn't show a sales increase. So they misstated the books a little bit, immaterial amount, but it shows a sales increase. Well, that would reverse a trend. If their sales were growing every single year and then this year they don't, it would reverse a trend. Or it's possible maybe they have a little bit of a loss. So we don't want to show a loss. We'll change the books by an immaterial amount, a small amount, to show that we have income. Now, there's a difference between a company that's showing income and a company that's showing a loss. There's weight given to that. A company that is profitable versus a company that's not profitable. So even though it's a small amount, if it reverses a trend, it could be material. Now, if there's fraud, if the fraud is done by a general employee, it probably isn't material. That it's not material. It was done by a different employee. It's not that big a deal. However, if the fraud is done by someone in management, someone who should be, who A, should know better, and B, someone who you're somewhat relying on to do the audit, that might be material. So, if you have a cashier that stole, $3,000 in a year, it might not be that big a deal. It's not material. They're a cashier. They probably don't have very much supervisory, whatever. However, if it's someone up in management, if you have a, chief financial officer that stole $3,000, that's a big deal, because now you have someone in upper management stealing from the company, and you need to rely on these people. If it violates a contract or a banking agreement, it could be. And this one sometimes comes up, especially with it could be larger companies, but also for a lot of times smaller companies. A lot of times smaller businesses, they'll get their financing through banks. And so usually when they do that, the bank will say, look, we'll give you this financing, but you have to get all of your financing through us. You can't get financing anywhere else. You have to come through us to get the financing, because we don't want you getting a bunch of loans all over the place. And pretty soon, you have all these people. So all your financing has to come through us. Well, it's possible that maybe someone in the business, they work out some terms of some, they buy an asset or something like that, and someone gives them financing for the asset that's outside of the bank, and so they might be in violation of the contract, or the loan agreement or whatever. Now, notice that who's going to get these financial statements? Well, probably the bank that loaned them the money is going to get these financial statements with the audit report. They're going to be relying on the financial statements to know that they're that the company's not in violation of their contract, of their loan agreement. So that might make it. So even if it's an immaterial amount, they got financing for a $2,000 piece of equipment. They're buying the equipment, and they say, well, we can finance that for $2,000. Oh, okay, well, yeah, we'll do that. That simple thing might put their contract with the bank, their loan agreement with the bank, in jeopardy. And a lot of times those loan agreements are, if you violate the contract, it's due immediately. So, a $600,000 loan or something, it's, you violate the contract, we need $600,000 today. So, they're pretty steep, the penalties on some of those. So you have to, so even though it might be immaterial, it might be material because, the bank's gonna be relying on it. Okay. So anything that violates a contract or a banking agreement, even though it's immaterial, you may it may become material because of that. Something that increases management's compensation. So they cheat a little bit on the books so that they can make bonus. If that's the case, it could be material in that even though it's immaterial amount, we just barely missed our number that we're supposed to get this year to get our bonus, or the sales of 5 million or whatever it is. So we'll cook the books a little bit just to get over that 5 million. We all get bonuses. Well, if they do that, then it's material, even though the amount that they're over, is immaterial. Meet analyst expectations or the company's public expectations. So if they have a analyst expectation that comes out to a certain number, meeting that expectation, cooking the books to make that expectation true, because they don't want, if they know if they don't come up, if they don't meet that analyst expectation, so these banks will have analysts that will say, expect General Motors to make how much earnings per share. And if General Motors makes that, the stock usually does pretty well. If they don't, a lot of times the stock drops. They didn't meet the analyst's expectations. So if they cheat a little bit to make an expectation, that might be material, and that they really didn't meet the expectation or what the client said they were going to do. I'll tell you a funny one about that in a second. Illegal acts that are felonies. So things like bribes to officials and insurance fraud, those sorts of things are felonies a lot of times, and those things would make it more serious, obviously. So even though it's immaterial, and generally we don't look at things that are material, if these come to our attention, they might become material. And by the way, I'll talk about this one, and I'll stop there. Foreign Corrupt Practices Act, this is bribing foreign officials. It's the same thing as that. It's bribes, but it's for foreign officials. If you do catch someone doing something illegal and it's not material, you give it to the client, and hopefully the client will come up with some kind of a remedy that you think is appropriate. So just like materiality we have for dollar amounts, for most of these, it isn't, oh, gee, they did this, they get a bad report. Hopefully they will change it. So if they increase it to get managers compensation, you tell them, no, you got to take that out because, you're doing that to increase your managers compensation. So hopefully they will correct it. And again, even if these things are immaterial, hopefully that they will see the light and correct those things. And even these things that are illegal, that they will get attorneys and see what they have to do as far as reporting this to the government and all that kind of stuff. If they do those things, you can still give them a clean audit report. But if they don't, come up with a remedy for it, then that can be a problem. Okay, so these are things that they're called qualitative, that they're not quantitative, they're not dollar amounts. A lot of times would be immaterial, but they become material because of the nature of them. I had a friend that worked for Commonwealth Edison, and an analyst gave them an earnings per share estimate of $3. So $3 even. And they hit it exactly, $3 even. Honestly, they hit it. It was just right in the middle, $3 even. So their chief financial officer calls them in and says, we can't put this out. They'll think we're cooking the books to match the analyst's expectation. So you either got to make it, $3.01 or $2.99. You can't put it at $3 because, then people think we're cooking the books. They weren't. It just came out that way. It just came out that right on the nose. So they started talking. He said, well, we don't want to bump it up because then it looks like you're creating a fraud. It'll look better than you are. So he said, okay, well, we'll go down. So they started making phone calls around to people in different departments. Is there anything you can write down? Can you write down some equipment or inventory or something? I don't know, a couple $100,000 maybe. If you can write. So they literally they knock it down to $2.99 because they thought the chief financial officer thought that people would think that they cooked the books to make the the analyst thing. So anyway, that's a kind of a funny one. Okay. And relevant assertions. I'm going to do a bunch of spacing here to get this all on the same page. All right. I'll give you kind of a definition of evidence that I think is useful. And that is that evidence is anything that corroborates, I'm sure I spelled that wrong, or refutes relevant assertion, which we'll talk about in a second. So evidence is anything that corroborates or refutes a management's assertion. So it either says management is right or they're not right. If it doesn't say either of those two things, it's not evidence. Well, the question is, what is a relevant assertion? What is that? And that's what we're going to talk about next. These are relevant assertions, sometimes called management assertions. And they're both explicit and implicit in the financial statements. And I'm going to stop this for a second and talk about it. When management gives you the financial statements, it's inherent in those. It's assumed that those are, for instance, complete. right? That when they hand you the financial statements, that they're complete. Everything that's in there is supposed to be in there. It's assumed that if there's, say, assets listed, that they exist, right? If they say that they have, 3 cars or whatever, when they give it to you, there's an assertion made that we have 3 cars, so that those 3 cars exist. So these are what they call assertions. You assume that they are that if there's a sales transaction for existence, if a sale was made, you assume that has occurred, right? So when they hand you these financial statements, there's things. Some of them are explicit, saying that we give you these and they're complete, whatever. But some of them are. It's assumed, when they hand you the financial statements, it's assumed that they are complete. Right? It's assumed that everything that they have on there exists. It's assumed that everything occurred. It assumes that the values are correct on those items, or that they're reasonably correct, fairly stated. These are all things that are, when the management hands you the financial statements, these are things that you would expect to have in those financial statements, that a reasonable person would expect to have. And those are the things that we audit to. We audit to with they call these assertions, management assertions or relevant assertions. But those are what we audit. Each one of those we audit to. And when there's something in an audit, a lot of times they'll say, well, which one of these is it, are you looking at? And so that's what we're going to, that's what these are. Where am I? Okay. So let's go with these, some of these assertions and see what they mean. Let me make these all red. Okay. So occurrence. What does that mean? Say, a sale has occurred. So if there's a sale in the financial statements, sale, say, on the income statement, that transaction has actually occurred. I should probably say a sales transaction. That's not how you spell occurred? Oh, 2 R's. My wife was an English professor, and she'd be giggling right now. Okay, let's take this. Completeness. So that all transactions are included in the financial statement. So if you have the sales, that all the sales are included in the financial statements. If it's a purchase, all the purchases are in the financial statements. All, whatever account you're looking at, that all the transactions are included in there. Authorization, this one usually isn't shown. I can't remember where I picked this one up. I saw this somewhere that they picked that this was shown as a assertion. The transactions are properly authorized. So the people who made the transactions were authorized to do so. This you usually don't see this one listed as them, but yeah, it can be. Okay, accuracy. Now, accuracy is tricky because we're not talking about overall accuracy. We're talking about for any transaction. and that is each transaction you expect that they would be accurate, even though overall we never say the financial statements are accurate. Again, this does not mean that so this is for each transaction. So if someone has a sale recorded, you expect that that sale would be recorded accurately. And every sale you look at, you'd have this assumption that they would be recorded accurately. We're not talking about the overall materiality, or the financial statements that are not materially misstated. We're talking about just the individual transaction. Cut off. Transactions recorded in the correct period. So that, if the sale is made on December 31st, it's included in the sales. If it's the sales made on January 1st, it's included in the next year's sale. This one's fairly, no, I'd say fairly. This one's about 10 years old. It's one of the newer ones, but not super new. Okay, classification. So transactions, transactions, assets, liabilities, transactions, assets, liabilities are correctly classified. So sales, expenses, all that kind of stuff. I'll tell you something else that it comes into play though. Let's say that you have accounts receivable. For Fred, let's spell Fred's accounts receivable correctly. Suppose Fred's accounts receivable is negative. In other words, we owe Fred. Should that be counted as an asset? Accounts receivable is an asset. So we have a customer, maybe the customer bought some stuff and then returned it or whatever. So the accounts receivable is that Fred has a balance of $6,200 that we basically owe Fred for. Should that be classified as an asset? What do you think?
If we owe, shouldn't it be a liability? Shouldn't it be a payable?
Yep. Yeah, you'd have to reclassify this. This should not be an asset. This is a liability. So, this is a reclassification of, you may have an accounts, and they may have, a big list of accounts receivable, but if Fred, Fred might be the only one that they owe money to. But you would say, look, you got to classify that as a liability. You owe this person or company or whatever money. Okay, presentation and disclosure. Presentation is the format of the financial statements. Oops. But also the footnotes. And you guys probably know that footnotes, a lot of times will have a lot of information in there. They'll tell you how you depreciate stuff, how the inventory is accounted for, and all that other stuff. So, presentation disclosure, the format of the financial statements and the footnotes. Existence. Does the asset exist? I guess that's a question mark. So existence, does the asset exist? So if they say they have, 3 company cars, do they actually have 3 company cars? And the rights and obligations actually kind of relate to this. So if they say they have an asset, you check to see, does that asset exist? Okay, do they have the rights to those assets? Oops. So, you might look and say, okay, they have, do have 3 company cars. Yeah, they have 3 company cars, but they may not own them. They may be on a lease. So, if they don't own them, it shouldn't be on their financial statements. That's a little bit. There's some new rules out now that are going to change that a little bit. But the rights, though, do they have the right to? Obligations are, do they owe? What do they owe? Rights to the assets and obligations. So do they own the asset? And what are they obligated to pay? So rights and obligations are in there. And those are times there are a lot of things that are not, you can't look at a car and say, okay, that car's leased and that car's not. Well, they may have a sticker on the back or something that says, from Enterprise or something. But, generally speaking, you can't simply look at an asset and determine that. A lot of times you have to dig into the paperwork to figure out if they have the right to the car and what do they owe, for liabilities. Accuracy, I don't know why I have that in there twice. Let me take that out. Take that, accuracy. Valuation and allocation. Valuation is what you value those things at on your financial statements. Valuations are fair. And allocations are systematic and rational. Allocations are things like depreciation. Let me change that. Let me bring that down here. So fair valuations used to be things like bad debt and accounts receivable and uncollectible accounts. you know, the accounts, is the uncollectible accounts estimate, is it reasonable? Is it fair? Is it you know, based on some kind of a formula, obviously, that would mean that there those valuation of the country was fair. And allocation is just matter depreciation, inventory, LIFO, FIFO, all that kind of stuff. Those are all considered allocations. So allocations, and when you audit those, you're looking at their method of doing it, and is it systematic? You know, can they repeat it, and is it rational? Okay. PCAOB. They have just 5 assertions. These used to be the old. These were the old assertions we used to have before the AICPA went crazy and added a bunch of them. They used to have. These were the ones they used to have. A lot of these are combined with these up here. So, for instance, valuation allocation. This is where cutoff would be. You know, most of these you'd also find in here. Most of the other ones they were combined in here. So this would be like a, you know, cutoff is in there even though it's not. Yeah. Okay. What time is it? Oh boy. I tell you what, let's take a break. This stuff's kind of dry. You know, it's being in accounting, I'm used to people nodding off. This is tough even by my standards. So why don't we let's take a break. What time is it? If they come back at what, 7:05? 7:05. Okay, so we'll be back at 7:05, and then we'll try to fight through some more of those. Okay, I made a change of plans here. This chapter 3 is just going on too long. I'm gonna postpone the rest of chapter 3 until next week. So I think what we'll do is we'll start in on probably proportional to size, which is another sampling method. It's a little more interactive, a little more I don't know, a little more watchable, I guess, or whatever you want to call it. But so I think we'll do that. So I sent it out in an email. I don't think I've received it yet, though. You guys, which means you guys probably haven't received it either. Let me.
It came through in my email.
Did it?
Yeah.
Okay, I didn't get mine yet. Where's mine? All right, I'm gonna go ahead and load it on here. Oh, there it is. Mine came finally. Okay, and it's loaded into Blackboard now at the very end here. Monetary unit sampling. Okay. All right, so let's hold on to chapter 3. I know that this one's taking a long time. Usually chapter 3 is it's 2 different chapters. There's usually a chapter on planning the audit. There's a chapter on evidence. I usually cover the evidence chapter first. This one puts them together, which is fine with me, but it just makes it for a very long chapter. So anyway, let's, what am I doing here? Okay, let me pull it up. I apologize for that, and I should have realized that there was going to be a little more. It's just hard. It's hard to go through kind of definition-y stuff for long times like that, and at some point, you wonder what is the point. That it's there's only so much of that stuff that can go in. So. Okay, monetary unit sampling. This is called, it's called a number of different things. A lot of times it's called probably proportional to size. Dollar value sampling. It could also be dollar unit sampling. It's called a number of different things, but it's all the same. And it's a it came out. By the way, this is a sampling that's only for auditing. This is specific to auditing. It's not really used for anything else. having said that, that doesn't mean it's better than classical sampling. We'll find out that there's pluses and minuses to classical sampling versus probably proportional size. But this is specific for auditing. And it's a fairly unique one. And one of the things about it is that, especially if you don't have very many errors or you don't anticipate having very many errors, you can generally have a much smaller sample and still you can get the same level of confidence with a smaller sample. So if you're auditing the 95% level, with classical sampling, maybe you have to take 320 items. Probably proportional size, maybe you can get away with 150 items, which is huge. I mean, you're talking about days of work that you can save by doing it this way. There's some other things too that are nice about using it, but it's unique to auditing, and it's specific for certain kinds of accounts that we will go through, and for certain types of accounts, it's actually fairly useful. So anyway, we're not gonna finish this today, but we'll get started on it. So let me stop talking and we'll start doing. All right. So this is the book calls it this, just so you know. This is what the book calls it. A lot of times in the CPA exam, you'll see it called that. Same thing. It's if it's not classical sampling, it's going to be this. So, okay. So here's what we do, and here's the idea behind it, is that I'm going to do this on a piece of paper. Stop sharing. Share this thing. It's sort of like this. We have a fuzzy camera. Yeah. Thank you, Doggy. Okay. So it's sort of like this. We have $5,000. I forget what these are. Either accounts receivable or something. Accounts receivable. Okay. So we have 5,000 of these accounts receivable. And so what we do is this. Here's the $5,000 that's in the. What we do is we break it up into chunks. We say, okay, instead of having all of the stuff that makes up here, we're going to say that we're going to split up into 5 items, and that each item is going to represent a $1,000 interval. That's what they call an interval. So we're going to have one item for each one of these. So we're I'm sorry. The little dog just did something. I hope you guys didn't hear that. So we're going to pick one item from each one of these, the total of 5 items. But that one item is going to represent the entire interval. And it's basically a kind of like we did for the ratio estimation for classical sampling. So we break it up into intervals. We choose one item to represent that entire interval. So this is kind of how we're going to go ahead with this thing. Okay, so. Okay, so I kind of already set this up. Find the sampling interval. Okay, there's the sample size is, click on this. The sample size is 5 items. So the sampling interval will just be the 5,000 Okay, so the sampling interval is going to be that every $1,000, we are going to pick an item. And I'll tell you what I mean by that. So the sampling interval is going to be every $1,000, just like on this thing over here. Okay, so here's what we're going to do. We are going to pick the items. We're going to look at the cumulative total, and the item that crosses the $1,000 threshold, we're going to pick that item. Then we're going to go to the next interval. So this will be at the $2,000 level. Whatever crosses the $2,000, we're going to pick that item. 3,000, you get the idea. So this is how we're going to pick our sample. Okay, so going down here, we look at the cumulative. Oops. Oh, I'm going to be careful when I do this one. So we are looking for, so here's the book value. The cumulative total is just all of them to date, so it's that. The second one is all of them to date, so it'll be like that and so forth. So it just keeps adding up, so 500 plus 200 is 700, 200 plus 600 is 1,300. So I should say 700 plus 600 is 1,300. So, they just keep going. So we're looking for those things that cross the $1,000 interval. So the first one is this. It crosses the $1,000 interval. All right, which item crosses the $2,000 interval?
Number 6, item 6.
Yep, perfect. Yeah, we get to 1950, and then this is the one that puts us over. Which one crosses the 3,000?
9.
9 will cross the 4,000, but this one will
Yeah,
cross the
8.
3,000. You're right, though. 9 does cross the 4,000. And then one more. Which one crosses the 5,000? 10. Okay, so these are going to be the items that we are going to pick in our sample. So we're going to pick items 3, 6, 7, 9, and 10. So these are going to be the items that we pick. So whichever item crosses that interval, we're going to pick that item. So, the interval in this case was 1,000. It could be anything. It could be whatever you come up with for however many items you have. Okay. So, I'm trying to think how I could do this so it makes, put it on the same page. And I'm drawing a blank. Okay, I'm going to, well, we can condense these, right? Okay, so I'll kind of condense those up a little bit. Okay, so here's what we're going to do. The first item is item 3. And we are going to jump around with our mouse for a little while. And then, okay, so here's what we're going to do. So we have the audit divided by the book. Okay, so the audit will be that. the book value will be this. And I didn't space this thing very well. We're going to multiply that times the interval. So the interval is $1,000. Now this first one's going to look a little bit silly. I should get rid of all these. You can tell this handout's more made for a classroom thing. Okay, so 600 divided by 600 is 1. 1 times 1,000. There'll be a projected value for that interval. So what we're saying is, if you look at these, this first item, this is okay, right? This is what we our audit amount we came up with was 600. What the client had on their books was 600. This is fine. Projected misstatement is 0. Oh, I know. Here's what I could do. I could okay. Second item is item 6. So go pick up item 6, and the audit amount is 560. Divided by the book amount is 800. Okay, well that means there's a problem. Multiply by the interval. And so what we're going to say is that this interval is 560 divided by 800. Time for Mr. Calculator. Do I have I do have that up. Okay, never mind. Okay, so 560.
0.7.
0.7. Okay, so that would be 700 then, right? So 0.7 times 1,000. So the projected value of that would be so 560 divided by 800. 0.7, and then we're multiply that by the 1,000. So this is what so notice what we did here. We projected, this is sort of like that ratio estimation. We took the ratio and said, okay, everything in this interval is going to be off by that same ratio. Kind of like a ratio estimation thing. So the projected value for that entire interval, this is kind of boring me too. All right, snap out of it. So what would be the projected misstatement?
So undervalued by 100 or overvalued?
You're right. It'd be overvalued by what, 3? So the interval is 1,000. So the projected misstatement would be 1,000 minus the whatever that. Hold on a second. So the interval is 1,000. Come over here. Minus 700. So the projected misstatement would be 300. Yeah, let's make that. We'll make that turquoise. Okay, so the projected misstatements. First one was 0. Everything was fine. I guess you could put this up here for that one too. I guess it's not. So this is the projected value, and the projected value is what we value that interval at. And actually, we're more interested in this over here usually, what the projected misstatement is. Okay, next one up is 7. 7. The audit value is 450. The book value is also 450, so this one is going to be $1,000. So the projected value of that would be 1,000. And the misstatement will be 0. Okay. So again, you can kind of see what, whenever everything is okay, the projected misstatement is 0. Okay. Let's see. So 9, we have a book value of 300. No, audit value of 300. I'm sorry, the book value of 750. Times 1,000. Equals some number. 300.
It's 400.
400. Okay, good. Yeah, so 400. So for 0.04, so that's be 400. Okay, so this is the projected value. So the projected misstatement, I'm just going to copy. I know it's being lazy, but hey, I'm a lazy person. Okay, so this would be 400. So this would be
600.
Yep. And 10. The audit value is that. The book value is that. So nothing wrong with that one. So the $1,000 interval minus the projected value of 1,000. Zero. Okay, so this is, oh, yeah, stuff hanging around. Okay, so this is kind of the idea behind the probably proportional size. And you kind of notice something here, and that is that now I made this a little more exciting than usual. That I mean, there's only 5 items. I made 2 of them bad. So if you ever audited something and 40% of the stuff was wrong, you throw a fit. But the idea is, okay, what would be the projected value of this thing? And the projected value of this thing is, you can take it a couple different ways. You could add up the projected value here, add up these 5 numbers, but more than likely, it's easier just to add up the projected misstatements. There's usually fewer of those. So, oops. There's only 2 of them here, so this would be what, 300 plus 6, 900. For what we're doing, it probably wouldn't be that big of a deal, but you could imagine if you had 200 of these, and if there was 2 of them that were off, we'd much rather just add up those 2 than the whole, all 200 of the the projected values. Projected misstatements are they total 900. So the projected value would be be 5,000 minus 900 equals 4,100. And I'll clean this up in a second here. So the 5,000 is the book, the total book value. Same thing as we have up here. Oh, so the projected misstatement would be 900. And the projected value would be this. Actually, if you add all those up, it should come up from that. So this is probably proportional, I should say that, monetary unit sampling. All right, now I want to kind of point out a couple of things that make this especially nice for auditing some of the accounts anyways. And that is up here. When you talk about these book values for items, notice something. If our interval is 1,000, what does that tell you? That tells you that any item, if it were more than 1,000, would be guaranteed to be picked, right? If you had something that was more than 1,000, it would at least cross one of the intervals, maybe two. So if you had an account, say it was worth $1,300, you'd be guaranteed that you would pick that item. All right. So notice the beauty of that if you're talking about auditing. What that means is if someone tries to bump up the numbers, say for sales or accounts receivable or whatever, the more they increase an account, the more likely it's going to get picked. And at some point, it's 100% that it's going to get picked. So if they increase an account by, say, whatever, if it goes over 1,000, it's guaranteed you're going to pick. You're guaranteed to find it. All right. So the more that they cook the books on any given account, you say, well, okay, well, they spread it out over multiple accounts. Again, the more they increase those multiple accounts, the more likely those multiple accounts are going to get picked. So anytime that you have, and this is actually good for overstatements. Anytime that they try to overstate what they have, this method means the more you try to overstate it, the more likely it's going to get caught. So for those accounts that you're likely to be overstated, this is a really good method, because the more that they try to cook the books, the more likely it's going to show up. And at some point, if they cook it on any given account over the interval, it's 100% sure it's going to get caught. So that's what it is. Now, here's what this method is not good at. Those things that are understated. Let's go back to it for a second here. Oops. Okay, what it's not good at is, so notice if we were to understate an account, if this one were 0, say, what would be the chance of it being picked? 0. So this method, it's good for things that are overstated. Sales, accounts receivable are the usual ones. Things like accounts payable, it's generally not so good at. Because if they put something in at 0, there's no chance it's going to get picked. Okay, so this method is good for overstatements only. So it's good when they're trying to overstate something. It's a good method to use. The bigger the item, the more likely it's going to get picked, and at some point, guaranteed to get picked. Okay, now it does do one more thing that is actually very helpful. You'll notice when we picked our sample that we didn't use a random number table or anything to pick this thing. So this method also picked the sample. One more thing that it does, is it automatically stratifies the sample. In that, any item might put you over the interval. It could be a $1 item that puts you over the interval, but it's not very likely. Bigger items have a much better chance of getting picked than smaller items. An $800 account is much more likely to put you over that interval than, say, a $5 account. The $5 account might put you over the interval. It can happen. It's possible, but that 800 has a much better chance of doing it, and so it automatically picks the larger items that are you more interested in. Not that it doesn't pick any of the littler ones; it just does it proportionally. One that's $5 is going to be whatever it is, whatever percentage that is of 800. It's little, less than 1%, whatever it is. But anyway, so that's why they call it probably proportional size. Is that proportionally? Another thing about the sample size, and I'm not going to get into it tonight, but we'll start on it next week, is that for classical sampling, you have to get a a standard deviation to pick the sample size. So you have to pre-sample, or if you worked it a year before, excuse me, you can take that sample and get it, but you have to get a standard deviation. This one you don't, and you don't do that for a very good reason. There isn't a standard deviation. It's one of the weird things about this sampling. If every dollar, it counts every dollar as an item. Every single dollar is one item. So, so if every dollar is an item, spell. If every dollar is an item, what's the standard deviation? I cannot spell the deviation. 0. There's no deviation between them. They're all worth $1. So there is no standard deviation because every dollar has an equal opportunity of being picked. Every dollar is worth $1. So this is unusual in that for a sampling method. That's not neat. For a sampling method, this is unusual because there is no standard deviation. It's 0. And that all works into part of it being a smaller sample. One other thing, though, we'll get into this a little bit later also, though, that it tends to be a little bit more tricky also, though, if there's a problem with the account. If you think that there's going to be problems in the account, this is not a method you want to use because it does not, you can't expand it very easily. With classical sampling, you just take another sample. That's not a problem. With this kind of sampling, probably proportional size, it's more difficult if you do run into a problem. And again, we're sampling, so you sample at the 95% level, that means that 1 out of 20 times you're going to have a problem, even if there isn't one. Because the sample you choose is not going to represent the population as a whole. So anyway, this is kind of the idea. Oops, it's kind of the idea behind it, though, is that you pick these items, and it picks the sample, it automatically stratifies it, and if there is an overstatement, it's more likely to be picked in this one, which is not the case for classical sampling. For classical sampling, you can stratify the sample, but if you put them all in the same sample, a $5 one just likely to be picked as a $50,000 one. Whereas this one says, no. The larger they are, the more likely they're going to get picked. And at some point, if they go over the interval, 100% sure it's going to get picked.
Professor, are you saying strata? Spell that. What are you saying? Stratify?
Yeah, stratify sample. Now, you don't have to do it for this one.
Okay.
I think, I can't remember. I think it's in the, hopefully it's spelled correctly. I think it's in the, one we did, sampling overview.
Okay.
Somewhere, maybe not. Oh wait, that's multiple choice questions. That's not what I want. I don't know what I did. Oh, here it is. I think I gave kind of I gave an example of it on.
Stratification. Okay.
Yeah. So a sample, and this is one of the areas that the probably proportional size is good at, is that it'll automatically do it for you, and it's based on the monetary unit. It's based on the dollar amount, so it actually says that every dollar has the same probability of being picked. So it automatically does this as an item that is $10,000, is 10,000 times more likely to be picked than one that's $1. You know, it automatically adjusts it to, and remember that when we sign off on the financial statements, we sign off on the dollar amounts basically. Now, I know I talked a little bit about the you know, there's qualitative things too, if it's fraud and all that kind of stuff. But basically, you know, for most companies, it's going to be the dollar amounts that you sign off on. So dollar amounts is a good way to have your sample set up rather than items. So anyway, it's good. It's good for something. It's good for overstating things that people will overstate: revenues, accounts receivable, inventory, things that people will be more likely to overstate. This method's good, and again, if they overstate it enough, it's going to get caught because it'd be more than the interval. Things it's bad at, things that are understated, things like liabilities, you know, accounts payable. Someone gets a bill in the mail, they take that bill and they put it in the drawer, they don't put it in the accounting system. How do you find that? We do have ways of finding that, but this is not the way to do it. Question there? Did I can't remember if is it you would test this due, or was that already in?
Say it again, what you asked?
I'm not very good at that. I can't remember if is there something that's due. I thought that there was was a test due today.
I thought we turned it all in a week ago.
All right.
Yeah, we had a test due last Friday, I think.
Oh, I think I graded. Did I grade them? I'll take that. I think I graded. I think I graded them. But anyway, well, I apologize.
It's a few grades missing. Professor, did you get them in yet?
I thought I got them.
Everything's graded on mine.
Yeah,
I only have 2 grades.
Let me see here. I'm not showing anything that needs to be graded. Let me. I'll jump in though and see if it's possible that there is stuff in there to be graded. It's not showing. It's not showing on my thing anything that needs to be put in. Now, if I don't have something in for you, if you submit it, I'll definitely put it in. So if there's anything missing on it, you know, go ahead and submit it. And I think I told you guys, if I didn't tell you this, I should have. There is no penalty for turning stuff in late. I encourage you to keep up, but you can definitely turn stuff in. So if you have something that isn't in there, didn't get turned in or whatever, and also you can take pictures of it. You do not have to rewrite it or put it into the document like I do. You be on notebook paper, however you did it, it's fine. Do not you know, redo it to turn it in.
Professor, I turned in everything, but I don't have a grade for everything.
It's showing in Blackboard that you turned it in?
No grade is there.
No, but I mean, but there should be a document there. If there's no document, if it doesn't show any document for you, it's not going to show it for me either.
I don't know.
Okay. Well, anyway, if it's not in there, you know. Now, if you did enter it in there and it is in there, and I don't have a grade for it, then by all means contact me. It should show up in there. Blackboard is not 100%, you know, so and especially if you turn it in using an app, a lot of times it moves up. But anyway, you can also just turn it in and take pictures of it and turn it in. There's absolutely nothing wrong with doing that.
I took pictures and emailed them to you, and that's when we were talking about
you
needing.
Emailed them, okay.
And you were saying from now on to turn them in the other way, and I said, okay. That was our last conversation.
I will go back. I you know what? I think I downloaded those. I don't think I put those in. Yeah, I did download. Okay, that makes sense. Let me go through my downloads and I'll
okay, and then if you're missing anything, I'll just do it again Now I know I can
Okay.
just upload the picture as well.
Yeah, but let me go through it. I downloaded, I think I downloaded everything for all the emails. So I'll go through those and
Okay,
my apologies. I thought I heard.
okay.
Anything else? Okay. Well, I'm not going to sign anything for this week. We'll just hey, next week we're going to finish up chapter 3. We'll probably finish with probably proportional size, and I think I'll give you guys multiple choice questions for chapter 3. I mean, maybe we'll do those in class to get extra credit points on them. So, okay. Any questions or anything? Okay. Tomorrow, I think I told you guys that my my office hours are going to be, I was going to change them tomorrow, but I'm not. I'll be here at noon and at 6 p.m. But I'll also be here other times to, you know, if you want to meet some other time, that's fine with me too. So just let me know. And you will not be disturbing me. You know, the only times I can't meet are Monday through Friday. Well, Monday through Thursday at 6 p.m. I have classes, and then Friday I have office hours at 6 p.m. But any other time I'm basically free. So feel free to contact me if you want to go over anything. Okay. Well, I will talk to you guys in a week, or maybe at office hours. But talk to you guys next week, and I'm not gonna sign anything. We didn't get far enough through on probably proportional size, and I still got stuff to cover in the chapter 3. And I apologize for chapter 3. In hindsight, I should have made it into 2 chapters, but.
Okay, so we don't have anything to do. We just need to continue next week with these 2 things.
You need to relax. That's what everyone